The Nigerian government has decided to float the Naira after many years of having the exchange rate at a fixed rate. Whether this will fix the economy is something that we'll explore in this video. The new exchange rate regime started when the new president Tinubu decided to fire Godwin Emefiele, who was the then governor of the CBN, and he replaced him with one of his deputies. As part of that policy, there was an immediate impact on the financial markets where we saw the exchange rate of the Naira to the dollar fall from around 460, where it was pegged before, to around 750 Naira to the dollar. Pundits have said that by doing this policy, Nigeria is going to be more competitive on the global scale, increase investor confidence, and allow Nigeria's economy to recover in a better way. What we're going to explore in this video is what does a floating exchange rate mean, and will it actually really help the economy? First, let's define what an exchange rate is. An exchange rate is the value of one currency to another currency. The most typical exchange rate is between someone's local currency versus the US dollar. And there's two predominant ways of setting an exchange rate. One is the floating exchange rate and the other one is a fixed exchange rate. There's a sliding scale between how fixed you are to how free floating you are. One way to understand a floating exchange rate system is to think of yourself in a market where you're haggling or bargaining for a good, for example, maybe potatoes or apples or the like. You're at the market tells you one price, you say, no, I want to pay this price, and you haggle back and forth and you get to a price. That's essentially what a free floating exchange rate is where the market decides what the value of your currency to the US dollar, which is the typical comparison that people make. Then the next option is like a fixed exchange rate. Imagine you go to that same market, but you want to buy something or haggle over something, and they say, look, these apples, the seller says these apples are $10 per kilo, and you try and bargain them down. They're saying, no, we're going to stick to $10. And that's kind of like a fixed exchange rate where the market is told this is the price for this good, there's no moving from this good. And that's the extreme end of fixed exchange rate policy. And in between, there's kind of varying degrees of fixed exchange rate to floating exchange rate. Some people have a fixed exchange rate that moves relative to another good or basket of goods, or a fixed exchange rate that goes between a narrow band. So it's almost like, if I were to use that same market example, it's where you might bargain with the seller and they say, look, I can only give you 5% or 10%, and that's the maximum they can give. Whereas in a floating exchange rate market, the market just says, the value of that currency to the dollar could go from 50% higher than the dollar or 50% lower than the dollar. It can be wild. There can be a lot of variation. It's very interesting to compare the floating exchange rate system to a fixed exchange rate system. Here are some of the pros for the floating exchange rate system. It allows the central banks to have more say about how they control inflation. It makes the country more resilient to trade shocks. And it also enables banks to be able to be lenders of last resort, and it avoids exchange rate risks. On the opposite end, we've got a fixed exchange rate system, and it has these advantages. One, it allows you to manage your economy, because if you know that your exchange rate is very volatile or very uncertain, it goes up and down by huge swings, having it fixed at a certain level allows to give a little bit more certainty and confidence to businesses and consumers. There's less likely people are going to speculate on your currency, particularly if your currency that kind of goes up and down a lot, because some people will see those opportunities of saying your currency go up and down a lot as opportunities to sort of put a bet to say, in a couple of days time, this currency is going to fall by 20%, and if they win that bet, they're going to make millions or even billions of dollars. Examples of countries with their floating exchange rate are US, India, and Somalia, to name a few. And it's interesting to see that we've got US, which is a high performing country compared to Somalia in this basket. And that's to draw the point that it's not about the exchange rate system that makes a country successful. It's other factors that are important, which I'm going to discuss in this video. If we look at fixed exchange rates, some examples are Denmark, UAE, and Singapore. We can see that, for example, the UAE is doing really well, and Singapore, which is one of the financial centers of the world. And then we've got Denmark, who is a European country that's been doing well for quite a while. Just to show you that it's not really about the exchange rate system. I'm just trying to drive the point. The key thing for Nigeria is not that the exchange rate system was the problem. Really, the problem was the complexity and lack of transparency in the way the exchange rate system was done. Godwin Emefiele's exchange rate policy was based on giving preferential treatment to some companies who were seen as essential in the economy, forcing other people to find other avenues to find the foreign exchange they needed. It went even further that some companies like the airline company, the Emirates, was not able to get money from the money they made through ticket sales in Nigeria, to the extent that the Emirates decided to stop flights into Nigeria. Clearly, this lack of transparency and ability for businesses to do business in the most logical way made it hard to invest in Nigeria and made the exchange rate system disastrous for the country that was trying to grow out of poverty. There are some warnings when you try and adopt a floating exchange rate system. The best environment to start a floating exchange rate system is where you have stable inflation, good employment, and good economic growth. And right now, Nigeria is not experiencing any of those three. So it's quite a bit of a gamble for the Nigerian government to go to a floating exchange rate system, even though, according to textbook economics, it seems like the most logical thing to do. In terms of the immediate impacts of the floating exchange rate system, one of the things we'll say is that because they've made the exchange rate go from closer to what the black market rate was, is that those people who are in the black market will lose their customers, because now those people will not need to go to the black market to get foreign currency, but will end up going back to the banks. I have mixed emotions about this, because for them it's kind of losing a business or losing a source of income, but at the same time having the exchange rate being done in actual banks also creates jobs for people who are in the banks as well. So it's kind of a blessing and a curse at the same time. Because the Naira has already fallen by quite a bit, probably going to see inflation rise in Nigeria, which is going to have an impact on how people are going to be able to purchase goods and services. With the subsidy being now removed for petrol, and also the government encouraging people to import petrol on their own, there's going to be huge demand for US dollars. And also with the fact that they're also trying to make sure that the people who are owed their money, particularly companies like the Emirates and the like who are owed money, can get their money, there's going to be huge demand for US dollars, which will probably depress the value of the Naira even further. All those things are in the short term. What should be the biggest concern is Nigeria's massive debt. If, for example, there's a crisis happens within the next few years and the Nigerian economy is still weak, what could happen is that, because there's a fear that the currency is going to fall, people might pull out their money from the Nigerian market. And what would that would cause the Naira to even fall further in value, and maybe even collapse, like really collapse, like go below even $1,000 to 1,000 Naira to $1. And this can have significant impacts on how businesses run their businesses, whether people can afford to buy the goods and services that they need. And that scenario could have massive impacts on Nigeria's economy and even take it backwards more than it's already experiencing right now. With that all said, it all comes down to this new governor being able to have a transparent floating exchange rate system that makes it more comfortable for investors to do business in. And also, if they're able to make the economy grow by producing more goods and services and exporting them, they will be able to turn around the economy and use their floating exchange rate and actually reap the benefits of having a floating exchange rate. So we'll be watching this space and seeing what happens in the future. And if you did like this video, I've got all my research in my Buy Me a Coffee page that you can check out. And I hope to see you guys in my next video. Bye.